Hi there, welcome to Kneppy Invest. A few weeks ago, maybe even up to a month ago, I looked at 10 companies that IPO'd in the first 4 months of 2016, and I just rated the performance of those 10 companies. But we had a significantly more amount of companies actually list on the ASX in that year. So I'm going to look at another 9 companies today that listed in 2016, just to see that how they have performed over the past 5 years. What I'll be doing is looking at the charts to see how the share price has performed, and also looking at the financials of the company, looking at the growth in revenue, operating cash flow. Also be taking into account the dividends, because one of the companies today has been a great dividend provider for income investors. So let's get stuck into it. But before we start looking at the 9 companies featured in this video, just a little review of the 10 companies I featured in the previous video. During the first 4 months of 2016, we did see a lot of Chinese companies list on the ASX. And in this particular list, we had about 5 such companies. And every single Chinese company, except one, which is Soon Mining, is no longer listed on the ASX. And the majority of them you would call pretty dodgy. A few other companies are no longer with us, including Total Face Group. They became Wellness and Beauty Solutions, then went into administration in March 2021. Monash Absolute Investments restructured into an ETMF and delisted in May 2021. And Abundant Produce decided they just wanted to become a private company, and they delisted in June 2020. Some of the other companies that did list on the ASX in the first 4 months of 2016 and are still on the ASX include companies like WiseTech, Tezzerent, OneView, Volpara, Vectus Biosystems, iCanty, Reese, and Novarti. Now let's have a look at the 9 companies I'll be featuring in this video. And the reason I'll be focusing on only 9 companies instead of 10 is all because of Tegel Group. Now, in this particular website, they are just looking at the codes of the company. And Tegel Group, which had a code of TGH, was actually acquired in 2018. But then came along another company called Terrigen, and they took the TIG code TGH. And that's why on this particular website, you might see that Tegel Group share price has fallen from $1.55 to 27 cents, but that's not exactly accurate because it's a completely different company. Now, in this group of companies, which listed on the ASX between April 2016 and June of the same year, you'll notice that there's no longer any Chinese companies that listed in this list anyway. So the run of Chinese companies has come to an end. And the only other company that made a little bit of a difference or change was Shark Mitigation Systems. They had a ticker code SM8, and now they're called Harvest Technologies with a ticker code HTG. And some of the other companies I'll be looking in this video are some fairly popular names on the ASX, including Afterpay, actually not Kogan, that's in the next video, Afterpay, Reliance Worldwide, Redbubble, and WAM Leaders. So let's get stuck into it. And the first company I'll be looking at is Motorcycle Holdings. First thing I want to look at for Motorcycle Holdings is how the share price has performed to the end of November. So all these charts are to November 29. And I just noticed that Afterpay share price was down about $10 or $12 from the share price I'll be showing you in this video. Anyway, the share price of Motorcycle Holdings was up or is up 29% from when it listed. They also issued 52 cents worth of dividends during the last 5 years. So the total return for Motorcycle Holding shareholders is 50.1%. If you calculate the compound annual growth rate of those returns, that gives us a 7.7% return for shareholders. That's an okay return. That's sort of an average return you might expect if you invest in ETFs or that sort of thing. So I'd say that's an average return. Now, the revenue has more than doubled, and the operating cash flow has sort of been in between tripling and quadrupling. And if you do actually calculate returns of revenue and operating cash flow, that's a 15% per annum increase in revenue and about a 30% increase per annum in operating cash flow. The other thing you'll notice is shares on issue have almost doubled from 32 million to 62 million. So there is potential. The reason why revenue and operating cash flow have grown over the past 5 years is because of some acquisitions, and to fund those acquisitions, they've done some cap raisings. So with a compound annual growth rate of 7.7% per year and increasing revenue and operating cash flow, I will have to give Motorcycle Holdings a pass mark and give it a B-. Onto a company I have thought about investing in the past, and that is Reliance Worldwide Corporation. Their share price is up 120% over the last 5 years and 6 months it has been. They've also issued 41.5 cents of dividends, so this is not a high dividend yielding sort of company. So not really the sort of company that income investors would like to have in their portfolio. But the overall returns over the past 5.5 years for Reliance is 137.6%. If you calculate the compound annual growth rate, that gives 17% per year. And that's the sort of returns you want to have per year for any sort of investments and for your portfolio overall. Now, if we turn our attention to the financials of this company, revenue has more than doubled. So that's a 15% increase in revenue per year. And operating cash flow has almost quadrupled per year. That's a 30% increase in operating cash flow per year. Shares on issue have increased, but not by all that much, from 541 million to 783 million. Again, maybe they have done some acquisitions. But with a compound annual growth rate of 17% per year and significant increases in revenue and operating cash flow, I'm going to have to give Reliance Worldwide Corporation an A- rating. On to the next company, one of the most popular companies for retail investors on the ASX over the past 5 years, Afterpay. And it should be no shock that I'm going to give Afterpay a rating of A+, all because of what's happened with the share price over the past 5 years and 6 months, up 3,994%. Now, this company is not profitable and not operational cash flow positive. In fact, in the previous year, they were operational cash flow negative by $571 million. But the investors of this company don't really care about the operational cash flow of this company. They're really focused on revenue growth. And revenue has grown from 29 million to 924 million. And investors of this company want to see the reflection of that revenue growth in the share price. And it's done exactly that. In fact, the compound annual growth rate in the share price is 96% per year. And for that reason alone, you have to give Afterpay an A+ rating. Now to the company that changed their business model from shark mitigation to harvest technologies. And under the old business model of shark mitigation, it was a complete disaster. The share price fell from about 25 cents all the way to about 2, maybe even lower than 2 cents. And as soon as they changed their business model, as soon as they made an acquisition of Harvest Technologies or whatever they did to change whatever they were doing, we have seen the market respond to that change, and we have seen the share price really take off from the end of 2019 when the share price was 2.5 cents. In fact, the share price rose from 2.5 cents to a high of 50 cents towards the start of 2021. The share price has been pulling back recently. In fact, the last 4 weeks, the share price has dropped from 33 cents to 22 cents. The share price is down 9 or 8% from when Harvest Technologies as shark mitigation systems listed on the ASX, but it has significantly increased from the end of 2019. But we are looking from when this company listed, not from when they changed into Harvest Technologies. No dividends, and if you do calculate the compound annual growth rate of the share price, it is down 1.6% per year. The market cap of the company is 127 million, which is significantly higher when the company was shark mitigation, because the shares on issue have increased from 36 million to 500 million, and more than likely they needed to issue a lot of shares to buy into Harvest Technologies. Very little revenue. Revenue has grown, although, from 400,000 to 8.3 million, and the company is still operational cash flow negative. And for the last financial year, it was negative by $9 million. Now, for the simple fact that the share price has gone down over the past 5 years, and even though revenue is climbing, this company is still operational cash flow negative, we have to give the rating of Harvest Technologies right now a D rating. But if you take a position of rating this company from when they transitioned from shark mitigation to Harvest Technologies back in 2019, probably have to give a much better rating than D, maybe even a B rating or something like that, simply because this company and the company's management decided they needed that transition because shark mitigation systems were simply not working. And I think that change in business model has worked for this company. Next company we want to look at is Redbubble. This company really benefited from COVID-19. We saw the share price during 2020 from the bottom of the COVID-19 financial panic when the share price reached 40 cents. Climbed all the way to $7.40 in the start or by the start of 2021. So a significant rise in share price during that period. Share price has pulled back by 50% since that high, but overall the share price has increased 131% since this company listed on the ASX. They've issued no dividends, which means the compound annual growth rate in the share price is at 16.5% per year. That is the sort of returns you would want to have in one of your investments. The market cap of Redbubble right now is 940 million. They have increased the shares on issue from 152 million to 272 million. They've significantly grown the revenue from 115 million to 657 million. That's a quadrupling in revenue. And they've gone from being operational cash flow negative to operational cash flow positive. So negative 4.7 million to positive 55 million. So a lot of things going right for Redbubble right now. The only thing I'm a little bit wary about is how much did COVID-19 benefit this company and whether we're going to see some of these financials actually decrease in financial year 22. And because I do or am a little bit wary, and even though the compound annual growth rate in this company is at 16.5%, I was thinking about giving this company an A minus, just like Reliance. But I'm just going to go one step back and give Redbubble a B plus rating. Next company we're going to look at is a company where you really got to take into account the dividends this company has provided the shareholders over the past 5 years. And that is WAM Leaders, or Wilson Asset Management. And if I remember correctly, WAM Leaders is investing in the best companies in the world, like Apple, Microsoft, companies like that. So you should expect some good returns over the past 5 years because of the companies this company will be having in their portfolio. And even though the share price is only up 31% over the past 5 years, which seems fairly mediocre returns over a 5-year period, if you take into account that the total dividends this company has provided for the shareholders is at $1.07, that leads to an overall return of 132%. So you can just see the significance of including dividends in calculating your overall returns, especially if that company is providing fairly good dividends. And if you calculate the compound annual growth rate of the total returns, we get 16.5% per year. And just compare that to the ASX 200, which over the same time period has given a 10% per annum return. You can see that this company does or has better returns than the overall market. And this is the sort of company, if you were an income investor, that would be a great investment. So even though the shares on issue have increased a little bit, that compound annual growth rate of 16.5% really is intriguing to me. So I'm going to have to give WAM Leaders an A minus rating. From a pretty good performer on the ASX over the past 5 years to a company that's totally disappointed their shareholders, and that is GTN, which I think is Global Traffic Network. Their share price is down 77% since they listed on the ASX. They have provided 18 cents of dividends, so the total return over the past 5 years is a paltry negative 68%. If you calculate the compound annual growth rate of the returns of this company. It's at negative 18.5%. That's the complete opposite to what you want. You want 18.5% positive, not negative. Now, the market cap of GTN is 110 million. Revenue's dropping. It's dropped from 166 million to 143 million. Operating cash flow has increased from 4 million to 6.7 million. You increased the shares on issue by 50% from 163 million to 247 million. So nothing is looking good for GTN apart from what's happening with the share price right now. We have seen a long period of consolidation with the share price. Share price is just going sideways. And it does look, just on the weekly chart here, that there is a potential turnaround with the share price and a potential return to some positive sentiment. And if this company can release some good financial news, maybe if they're starting to grow revenue, the operating cash flow is starting to expand as well, we might see this company's share price take off from here. Just potential at this point in time, but I do have GTN on one of my turnaround watch lists. Oh, and I completely forgot to give a rating to GTN based off the compound annual growth rate of negative 18.5%. And even though the share price looks like it might be wanting to turn around, I have to give GTN a rating of E+. Second last company we'll be looking at is 9 Spokes. And if you ask me what this company does, I would not be able to tell you. Maybe 9 Spokes has something to do with cycling because of spokes. And that does look sort of like a chain on a bicycle wheel. I have no idea. And one of the reasons I have no idea is because this company does not excite me at all when you look at the chart, when you look at the financial state, and when you look at the fact that this company is highly dilutive to the shareholders. Share price is down 92% from when they listed on the ASX. That's a compound annual growth rate of negative 37% per year. That is absolutely awful returns for their shareholders. Current market cap is 20 million, and keep that in mind when we look at the next company. And keep in mind the revenue growth for 9 Spokes. Revenue has grown from 700,000 to 5.7 million, and even our operating cash flow has gotten worse over the last few years from negative 3.4 million to negative 5.2 million. It's not quite as bad as the next company we'll be looking at. And the shares on issue have tripled from 424 million to 1.5 billion. And when you look at the chart, nothing at all exciting there. In fact, the share price is moving down at a slow and gradual rate. So overall, you're going to have to give 9 Spokes one of the lowest ratings, and that is an E-. Not quite willing to give it an F. I've only given one company an F. That was in the previous video. And I think that company has been suspended for a while, and that's why I gave it an F. So I don't think you can get any lower for an actively traded company than E-, and 9 Spokes gets the worst grade possible. There is a reason why I mentioned this company Live Hire in the previous slide, and that has to do with the revenue operating cash flow. Both very similar in these two companies, but there are big differences between 9 Spokes and Live Hire. For instance, Live Hire share price is actually up 66% since they listed. And you can see there was a lot of excitement in this company. For the first 2 years, it was on the ASX. In fact, the share price rose from about 12 cents to a high of $1.50. But then we saw the share price fall from that $1.50 high all the way back to 6.5 cents during the COVID-19 financial panic. But the share price has been recovering since then, a gradual recovery, but the share price is increasing. No dividends, but the compound annual growth rate in the share price is just under 10% per year. That's okay returns for a company you do own. The markup is 110 million, which compares to 9 Spokes, only 20 million. But look at the revenue in Live Hire, very similar than 9 Spokes. So the revenue has grown from 300,000 to 5.5 million, and the company is operational cash flow negative in the most recent year by 5.5 million. So very similar to 9 Spokes. But there's a little bit more positive sentiment in Live Hire than 9 Spokes. And the shares on issue has also almost tripled, just like 9 Spokes. But because of that positive sentiment, instead of giving this company a really bad grading, and because the share price has increased 66%, which is a 10% return per year, you have to give Live Hire a C+ rating. The only thing holding me back from giving a high rating is just the financial state of the company. That's all I have for part 2, but I am planning a few more parts in this video series because there's a lot more companies that did list on the ASX during 2016. And this is the next group of 10 companies that I'll be featuring in part 3. And again, you don't see any Chinese companies in this group. In fact, the only company that has made a change over the past 5.5 years is Graphex Mining. They've turned into Marvel Gold. All the other companies are still on the ASX, and some of those companies include Drone Shield, Chimp Change, which I think might have changed the name but still have the same code, and then 3 retailers, Shaver Shop, Kogan, and Michael Hill International. So I'll be doing this video in the next month or so look out for that, particularly if you like to see the performance ratings of companies that have IPO'd in 2016. That's all I have for this part 2 of companies that IPO'd in 2016. If you disagree with some of the ratings I gave some of these companies, I'd love to hear your opinion on why I am completely wrong. So leave it in the comment section of this video. The last thing I do have to mention is that I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.